All right, so the dollar was falling very, very dramatically, showed a lot of weakness. And for that reason, I was saying that we need to go short on the SPY. So that clearly worked out. So in today's video, we're going to talk about how all of these trades basically worked out. I'm going to give you guys my thought process of why I was bearish. And then I'm going to talk about some more stuff. So in today's video, we're going to talk about the S&P 500, the NASDAQ 100, the IWM Russell 2000, the dollar, the VIX, the bonds, all that good stuffs. Without further ado, let's get started with the video. First and foremost, everybody. So I really want to start doing trade coaching. So what that means is you guys would just email me trades and specific details of your setup, and then I would critique them via a YouTube video. Okay. So have you ever taken trades and wish you understood what you did wrong and could do differently? I'm expecting emails. All right. So this is basically all you need to provide me in that email, so that I could go back in time, look at what was going on, and then critique it. Basically explain what you could have done better, what you did wrong, and how to become a better trader. So obviously you need to provide the symbol, the time and date entered, the time and date exited, price entered, price exited, reason why you entered and exited, and then your pre-trade plan. All right. And then also if it was an options trade, you need to tell me what your option contract was, the strike price, and the expiration date. This would also force you guys to start documenting your trades. So this is another think of that would make you guys better traders. And 100% like send me your emails. My email is hamidtrades1@gmail.com. It's right here. I'll also put it in the channel description of the video. Please send me this stuff. And yeah, I have a very, very strong feeling that this would do really well. I'm going to post it in YouTube videos. I'll make probably 2 or 3 videos a week describing these trades in detail. All right, cool. Pause the video, read over this, and yeah. All right. Now, we have clearly been on a very, very hot streak here. So we swung SPY puts. All right. And the reason why we were swinging SPY puts was because the dollar was extremely weak. And when the dollar is this weak, that means that the overall market should end up falling. All right, so let's go ahead and take a look at that. All right, so number one, we know that the dollar has an inverse relationship to the market. If the dollar is looking to bounce and do strongly, that means that the stock market should be falling. Money will exit the stock market and enter into the dollar. That's basically what ended up happening. So the dollar on Friday was opening outside of the lower level of the Bollinger Band. That is extreme overextension to the downside, and it means that the dollar should bounce. Okay, every single time that we've seen this happen where the dollar is opening outside of the lower Bollinger Band like this, we've always had a pullback in the S&P 500. That is the main reason why we went short. And that's why it worked out beautifully. So we could take, basically all you would need to do is look at any other point in the history when the dollar was opening outside of the lower Bollinger Band, and then pull up a chart of the SPY. You'll see that the SPY falls over while the dollar is bouncing from these extremes. And we took a look at a few examples before. So that's basically it. All right. So right now, what we need to look at the moment is how high the dollar can bounce. Okay. So there's 2 ways to do this. We can take a look at from the recent swing high to the swing low, and you can see that the dollar came back and broke above the 38.2% fib. Now, if this is a bear flag, right? Bear flags are bearish patterns. Okay? And generally, the price comes between the 38.2% fib and the 50% fib. So that's basically what already happened. Okay? We made a bear flag. We came and tested between these 2 levels. Cool. Now, what needs to end up happening for a continued move up is we need to break above the 50% fib. And that could be a bit difficult because now it's starting to look like it's starting to become a better short again. And I'm going to explain why. But the easiest trade was to have gone short the market when the dollar was like this. But right now, the dollar is in a bit of an interesting spot. The entire market is in an interesting spot because it needs to continue making a decision. So there's that for the dollar. Next, I want to take a look at the VIX, and then after the VIX, we're going to take a look at the overall stock market. All right, so this is a chart of the VIX. Clearly, it's going through a tough time. It's having a hard time choosing direction. All right, it's anyway, yeah. So basically, the VIX. If the VIX is showing strength, then the market is doing badly. The VIX has the same correlation to the market that the dollar has. It's an inverse relationship. And right now, the VIX is not showing us anything except that there is a lot of downside potential. Technically, there's a lot of downside potential. The lower B bands are sharply falling lower, which means that the VIX can easily break lower. And if the VIX breaks lower, that means that the stock market is going to bounce. So that's technically what's going on, right? But then also we are holding this 13.5 support on the VIX by a thread. So we're in an interesting spot here on the VIX. All right, so it's not really showing us that much. Next, I want to take a look at some interesting images. All right, so this is an image. Shout out to Undivine Night for sharing this image with us here. This is essentially cycle analysis. So we're getting different cycles here, and each blue line here basically shows a market bottom or a market top. So we're getting to a point now where the market should be getting a bit of a pullback. So it's going to be pretty interesting what ends up happening here. So this is showing that things are getting to a point where we're getting to a pullback in terms of cycle analysis. Shout out Undivine Night. Next, what I want to look at is basically so the June swoon midsummer rally when preceded by a positive quarter for the last 30 years. Okay, so we've had a positive quarter. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. 23 times in the last 30 years. So this is documenting that whenever we had a positive quarter between March and June, we look at the data between June 19th and June 27th, and we can see that 18 out of these 22 times, the market has fallen. So for now, right, from June 19th, we're on June 20th now. We are down on the SPY 0.52%. So we've already started to fall. And it goes in line with the 18 times. That is a very strong majority. 18 out of 22 times we end up falling between June 19th and June 27th. We have an overall red percentage. Okay. So during this time, I'm going to be leaning a bit short. And then it's very, very interesting when you look at June 27th to July 23rd. There is 19 out of the 22 times we are up, and we end up being green during that time. So the month of July, we're going to be bullish. So heading into the end of the year, we're going to be bearish. So basically, this is another interesting data point that I want to share with you guys. And I hope you enjoyed this. So also, in case you guys haven't already, please make sure to subscribe to the channel, put on your bell notifications, like the video, comment anything. Make sure to email me your trade idea so that we can go in detail about the trade, and hopefully I can help you guys. But once again, please subscribe to the channel. I really, really appreciate all of your support. Let's continue on with the video. We're going to take a look at the S&P 500, the NASDAQ, and then the Russell 2000. All right, so number one, this is a chart of the S&P 500. We went short Friday on the option contracts. They hit 45, 50% each. And we sold literally at the bottom around 435.50. And my reasoning for that, well, let me open it in the chat actually. So the reasoning for that, so basically from a risk standpoint, we are at the lows. And as more and more people short down here, the higher probability we have a bounce. We are essentially risking all profits for the assumption SPY can go back down to 433 and 430, etc. And it doesn't make sense to be greedy for a few extra points. So I called this paper handing. 38% profit. I did not want to sell, but I knew that it was the best point of action basically to sell. And so anyway, we ended up shorting on Friday because the dollar was also obviously very overextended to the downside. And now we are at a very interesting point on the S&P. We have resistance here at 437.68. So when we're taking a fib level from the recent highs to this low here, the fib has not broken above the 50%, right? Nor has it broken above the 38.2% fib. And we were looking at the dollar's Fibonacci level. So if this is going to create a bear flag, and if we're going to continue falling lower, right, the SPY needs to remain below 439.40 or 440 for this to continue falling lower with dramatic speed, okay? And if we end up breaking above this level, and if we end up closing above 440.5 on the SPY, then it becomes very, very interesting to short. But essentially, at that point, so basically what I'm looking for is I want, before we re-enter into shorts, personally, I wanted at least 439. I wanted around 439 basically to go short, because that would be like the safest opportunity. And with that, you'd have like a 10-15% stop loss with contracts about like a month away. Now, of course, as we bounced to 438 today, that was also another good opportunity to short with a 10-15% stop loss as well. But the most patient trade, in my opinion, is waiting for 439 or 440 area and then shorting there. So hopefully we get a bounce tomorrow. But regardless, you know, this is clearly showing weakness. The overall momentum is bearish right now. And the SPY, these are the two levels that we need to basically remain below. All right. Next, the IWM, basically similar concept. We're holding support here at 185. So we had a big drawdown on Friday, had a bigger drawdown today, and then we bounced up similar to what the SPY did. All right. Very simple. Holding above 185. Nothing to really look at here. The NASDAQ, same concept. Friday was bearish. Blah, 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 blah. Everything is now at support. All right. The NASDAQ is at support. The IWM is at support. The SPY is at support. Now it's just a matter of how much higher we can get a bounce. And once we get to that bounce, is this going to be like the best shorting opportunity? Which the bias is going to be bearish, right? I am a bit bearish. So if we get a bounce, will that be a good opportunity to short? Or will we close above this level and bounce? That is still yet to be determined. But one of the reasons why I think something like that is starting to become a bit far-fetched is Tesla. So Tesla is showing massive strength here on Tesla. So it filled multiple gaps. It is on an absolute tear. And from a percentage standpoint, Tesla is up 80% in the past 54 days. So with Tesla like this, it's getting a bit difficult to continue to be extremely bullish on the market when Tesla, which is a very, very strong, imagine if my point being is that if Tesla was not up 5% today, right? You can see Tesla was up 5.34%. If Tesla was not up 5.34%, and if Apple was also not green today, then imagine where the market would be, right? So what I'm saying is I don't think that this move in Tesla is obviously going to be sustainable. And, you know, I hope for everyone that's long Tesla, sure, it can continue like being bullish. But my point is that in the short term, we're not going to continue seeing 2, 3, 4, 5% green days on Tesla. So as we start getting a bit of a pullback or some sort of weakness out of Tesla, that weakness can permeate into the rest of the market. So that is basically what I'm trying to explain. When you take a look at Apple held its own and it was bullish as well. Like it had a green day actually. But then when you look at AMD and the chips, AMD was very weak, but then Nvidia ended up making another high. So the chips are at odds. Google looking very similar to the IWM. It's having a tough time deciding what it wants to do. And Microsoft continued with its red day, which is understandable. Okay, so putting all this together, the main levels essentially are, let's just take a look at that on the SPY. Okay, so these are the most obvious levels of support and resistance on the SPY. Okay, so you would rather, so instead of shorting at levels of support after base. Before I even begin explaining, all right. So number one, we clearly see that there was a big move to the upside, and then a big red day, and then followed by another red day. Okay. Instead of going short as levels of support are being held here, the risk reward essentially for going short, say for example, you wanted to go short at 435, the risk reward, so going short at 435, there's support down here at 433, and then at 432, and then at 430. So say for example there's a 5-point downside for going short at 435. So your reward would be 5, but then your risk would also be 5. Basically, your risk, it could easily break back above 435, above 440, and it could easily clean break back up to 442. So the best place to go short is when you can mitigate your risk. So let me really try to like drive this home. So now say for example, you want to go long a stock at 100, okay? And you have a stop loss at 98, and you have a take profit at 106. So your risk to reward, basically you're rewarding 6 points and you're risking 2 points. So your risk to reward is your basically that number divided by itself. So 6 divided by 2 is 3-to-1 reward to risk ratio, and that is a very, very good reward to risk ratio. Going short at 435, you're basically, your reward is only 2 points to 433 or 5 points to 430, and then your risk is that 440 level. And then even if like it bounces back up to 442, 443, your reward to risk ratio is either 1-to-1 or less than 1. So that is terrible. So the main thing is when you're trying to take trades, you want to have reward to risk ratios that are at least 3-to-1. So going short down here at 435 was just a very, very bad trade to take. And you want to have bounces back up to these levels of resistance so that your reward to risk ratio of going short at these levels at 440, for example, going short at 440, your risk is 3 points and then your reward is 430. So that's a above 3-to-1 reward to risk ratio. Does that make sense? So that, hope that made sense to you guys. Yeah, man, thanks so much for watching this video to the end. If you guys watched all the way to the end, you guys are MVPs, and I really, really appreciate your guys' love and support. Please make sure to subscribe to the channel if you haven't already. Definitely send me your trade so we can make like a trade recap of the videos and everything like that. And yeah, I hope this made sense. All right, so without further ado, that doesn't even mean. Take care. All right, I'll see you guys bright and early tomorrow morning. Thank you.